big global decisions are quietly moving markets. And if you're an investor who's paying attention, you're likely curious about how energy, resources, and influence will matter in your financial decisions. Stick around, we've got some answers. Welcome back, everyone, and Happy New Year. My name is Tara McBride, and I'm the Chief Marketing Officer at Prime Capital Financial. For more than 40 years, our firm has helped thousands of investors feel more confident in every step of their financial journey. Our clients are at the core of everything we do, and we believe empowerment begins with information, which is why we take the time to unpack the latest news and get to the important stuff that headlines simply cannot tell you. Today, we're digging into two developments that have investors brushing up on their geography: heightened U.S. involvement in South America's resource-rich nation, Venezuela, and renewed discussions around strategic influence in the Arctic, most notably Greenland. Energy, trade routes, national security, rare resources. This is geopolitics with a major balance sheet impact. I'm joined, as always, by two guys who I know would crush me in a game of Risk: Portfolio Manager Clayton Allison and Deputy Chief Investment Officer Will McGough. And for those watching, if you're wondering how global power shifts like these could affect your investments, scan the QR code on your screen to connect with one of our financial professionals. Let's get into it. All right, Clayton, when the U.S. increases its influence in energy-heavy regions, markets tend to react quickly. What are you seeing right now in oil, commodities, and related equities? And are those moves more about short-term volatility or longer-term structural shifts?
It's I don't know if I could win in Risk right now. It's been many years since I've played that game, but I would definitely win at Civilization. That's a different game I play a lot. But to answer your question, yeah, when things like this, especially on the geopolitical world stage, happen, things move very quick and pretty much move violently. Now, what we've seen pretty much in energy markets hasn't been a lot of whipsaw lately. I mean, oil and gas have largely traded range bound over the last, couple weeks ever since this incident occurred. I haven't seen a huge rally in oil. Pretty much been sideways. There was a little bit of a tick up last week, but nothing substantial. The main commodities that we've seen that have really rallied because of this have been gold, silver, those safe haven type of assets. Gold's now trading at an all-time high. It's over $4,000 per ounce at this point. So that kind of lends credence to, okay, geopolitical turmoil continues to increase. I want to have a safe place to put my money. And you see a lot of those flows going in. Now, we're talking more from the individual equity kind of standpoint. We did see, obviously, a major boost in a lot of major energy companies over this past week since this has happened. But namely, it's been more of those refining companies and those E&P companies, so more of the upstream type of names. So like Schlumberger, who has a major international presence when it comes to drilling. Valero, who is the largest independent refiner in the United States. Now, a lot of that is because of the fact that Venezuela sits on tons of deposits of heavy sour crude, which is very hard to extract and refine. So at that point, the president and the administration has said that they're going to be investing billions of dollars to update the infrastructure in Venezuela, but this has been decaying over decades at this point. And a lot of these energy companies are a little bit hesitant to go in there and invest a lot of money over the next decade or so when they've tried that in the past. I mean, ConocoPhillips, ExxonMobil used to operate there, and then they got their assets nationalized by Nicolas Maduro's predecessor, Hugo Chavez, back in the early 2000s. So until there's some guarantees behind this as to what they're trying to do, they are a little bit hesitant to just go in there and deposit billions and billions of dollars into a hostile type of nation that may not want them there extracting this oil at this point. But the main beneficiaries have largely been infrastructure names, drilling companies, refining companies, more than anything.
Yeah, and I have been hearing on the news some commentary around how much time, how much investment it takes for these mining companies just to even start to gear up again. So I have to imagine that there's a lot of questions with these companies that would even initiate this kind of work, right?
Yeah, I mean, obviously the main ones they go to are the industry leaders, what you would consider oil majors, so Chevron, Exxon. Because where it comes in the whole energy supply chain spectrum, you have upstream, midstream, and downstream companies. Chevron and Exxon do all three parts of that. Upstream, you've got drillers. Midstream, you've got pipelines. And downstream, you've got refiners and gas stations where they're selling the gas. Now, Exxon and Chevron are some of the major names because they are the ones with the financial backing to be able to provide all of those services and can commit that type of capital over the long term. The smaller, more regional kind of companies that you might see here, especially in West Texas and the Permian Basin, probably don't have that financial uplift that they can go into Venezuela and try to make a killing off of this massive opportunity, because it is a massive opportunity. Venezuela is probably the largest oil-rich nation that has not developed their infrastructure to get this out of the ground. Now, one aspect of this that some people might be missing is the fact that this could also be more of a political pressure play, not just an energy market kind of play, because China does get around 4% of their oil imports from Venezuela. So it's not a huge amount. Like, obviously, they're on the smaller side of things when it comes to OPEC and those other energy development companies, but it does lend some pressure to China and creates more tension in that geopolitical spectrum.
Will, from a portfolio construction standpoint, how do you think about positioning when geopolitics and natural resources intersect? Are there specific sectors or asset classes that tend to quietly benefit from these kind of strategic realignments?
Right. And so thanks everybody for joining this year. It's our first one of 2026. I think Clayton hit up some really good talking points, and I'll kind of tailor them to the two different implementations. The easiest is gold for natural resources as we're thinking about what's going on in the Arctic region. It's a tough one to include in a portfolio at a high level for something that we would run as per se like a model, but specifically with regards to your individual circumstances and working with an advisor, gold makes sense. It's a client by client type of asset class, in my opinion. And then when we think about energy, it plays into everything. So a lot of the administration's initiatives right now are to bring energy prices down to help, make the consumer a little bit more resilient. And those also feed into a lot of the other themes we've seen with AI helping margins. Well, energy prices are a cost of doing business. So energy prices staying low also helps margins, and S&P 500 is at record margins. So I think this lower energy prices through potentially some geopolitical conflict here actually helps increase the margins and gives a little bit of a resiliency to the S&P 500 and the projections for this year, which are pretty ambitious in my opinion. So they certainly play into portfolio positioning in different ways. With regards to specifically, got to get into the individual circumstances there.
Absolutely. Always, right? Talk to an advisor. That's our theme. When global leadership signals a more assertive, less traditional approach to international influence, how does that change the way markets price risk? Are investors underestimating or overestimating the long-term implications? Will, do you want to kick us off with that?
Yeah. So we've talked about this one ad nauseum over the last, call it 16 to 18 months. Really, since global financial crisis, the U.S. markets have been dominant on the global landscape. I saw a stat the other day that there's been 200 plus $10 billion or more companies created in the last 15 years in the States, for just 10 or so over in Europe. So that really leads to the U.S. market being the global marketplace. Well, that's shifted a little bit, specifically in the last 18 months. And it all has to do with my opinion in capital flows. The new administration is pushing NATO members to spend more on their own defense, up to 5% of GDP. And lo and behold, here in the States, recently we got a 4.3% GDP growth number. And what happens with the administration? They ramp up our defense spending from a trillion to $1.5 trillion. So there's just capital flows drive asset prices. It's supply and demand at the most simplest form. You want to follow money where money is going, prices tend to go up. And so I think that from an asset class standpoint, it's more money being spent is a good thing. Now, what that does with debt and deficits is the $1 million question. Could pressure long end rates. So bond markets could get a little tricky. But with that, Clayton, kind of curious if you see anything on a more micro level.
Yeah, I mean, just piggybacking off of everything that Will said, I think one major thing that people may overlook is the fact that when all of this starts to take a more assertive stance, like you said, Tara, there's inherently going to be a higher geopolitical risk premium applied to the entire marketplace. So where some people could be maybe underestimating or underpricing some things that are going on is really like kind of what Will said. Where's the money going? Well, it's going to defense spending. So some people may be underestimating the prolonged amount of defense spending that's going to be going out into the marketplace over the long term, as well as, the fragmenting of larger global trade. Like, there are largely two major superpowers in the world right now. It's the United States It's kind of China, and it's starting to diverge globally. And certain countries are having to pick sides almost as to who they want to kind of appease on the global stage to play ball, so to speak. So every kind of interaction that's going on, especially internationally between countries, whether it's policy or trade, is going to have rippling impacts, globally and worldwide. Now, one thing that I think people might be overestimating is that this is all going to collapse immediately. Globalization that's been built out over 30 years now is going to disappear overnight. And that's not going to happen. Supply chains are too ingrained, too complex, and too wide sweeping globally to just, hit the button overnight. Obviously if World War III happens, then it probably does, but that's probably not going to happen, anytime soon, knock on wood. But that's largely to say, I think that's probably the main one people are overestimating, is that, hey, every time China or the United States makes a move or creates a conflict or becomes an adversary via trade, everything's going to collapse in and on itself. But these are very slow moving regime structural changes that take place over years and years and years.
Yeah, that's even just what we were talking about a few minutes ago, where the amount of investment, the amount of time that is required to make these huge structural changes, it's enormous. And so I think there's some of this, quick, instant gratification kind of a world that we live in. We think these things change on a dime, and they really cannot. They will not. Yeah. So that's great perspective.
Sometimes the capital markets will move a lot faster than actual economic regime changes will. You'll see a name move 5% in a day, 10%, 30% in a day, but that doesn't mean the underlying fundamentals of what's going on in the real world are actually reflective of what the market showed.
Right. So zooming in, Will, how does geopolitical uncertainty like this affect interest rates, credit spreads, capital flows? Does it create opportunity in fixed income or demand more caution? What are your thoughts?
Yeah, so kind of always spoke to capital flows. Interest rates are all driven off the Federal Reserve and how they're moving policy. We know we have that new Fed governor coming in, or new Fed chairman coming in here in a couple of months. And so again, more spending works in certain environments and doesn't work in other environments. And it really depends on the strength of the economy. And if we think about the economy, it's classic K economy right now with tech and AI, driving earnings growth higher. I do think this is a really interesting topic that's kind of falling into the number 2 theme right now. AI takes so much space in our conversations this day and age, but if you look at some just boring ETFs like industrials, there's new manufacturing ETFs we were looking at the other day, they're up just as much as some of these AI themed ETFs are as well. So spending by governments, again, is dependent upon health of the economy. And right now we're in a decently healthy economy, but we have to watch what's going to happen to interest rates. We saw a preview of it potentially with the tariff fiasco in Q1 of last year. If the economy starts to weaken while you're ramping up spending, then people start to worry about inflation. And so where rates go, again, is the $1 million question. And it's all about, in my opinion, taking the right amount of risk assets, its exposure to risk assets with equities and systematic risk. And right now, things are super healthy. And so you would look to bonds and rates as a diversification, and even some of the stuff we talked about earlier, natural resources, gold, and other type of alternative as well, makes some sense in a portfolio.
Yeah, you mentioned something about some boring opportunities, and I don't know about anybody out there, but I kind of like my money boring. I like it to just kind of grow and do what it needs to do without taking, I risk is good, but measured, right? And working with a financial advisor helps you understand how much risk to take and how to keep the boring parts nice and boring and happy. So this was great. Thank you guys. Clayton, Will, it's always great to see you. And to everybody listening, this is a perfect reminder that global headlines aren't just political theater, they're market signals. Energy, access, trade routes, national influence, and global stability all have a way of showing up in portfolios, whether investors realize it or not. If you want to talk through what these global shifts could mean for your investments or long-term plan, scan the QR code on your screen and connect with one of our financial professionals. We also have a resource that is directly related to the topic we're talking about today. You can access that in the link in the description, or when you scan the QR code, you can access that download. Thanks for watching. And remember to stay informed, stay invested. And as always, we'll be here to help you navigate the twists and turns of the market. Until next time.